Hi, I'm James Robinson, and this is my stock pick of the week. This is my second video on the company Paychex, symbol PAYX. In this video, I'm going to talk about the operations of the company, which is really a look at how good a job the company does in delivering its goods and services to their customers, how efficient they are in doing that. So before I get started, this is a map of where my known subscribers are, and it's kind of one of the things that I really enjoy about doing this is getting to meet people from around the world who are also interested in investing. And also it's kind of a point of pride that I've got people following me from so many different places. So wherever you are, if you subscribe and you're following me and you like these videos, do me a favor and just write down in the comments the city and country you're from so that I can put your dot on the map, and hopefully this thing gets more and more full as we invest together. So when I look at the operations for a company, the first place that I always look is gross margins. And I look at, by the way, gross margins. You almost will never see me talk about a company's stock price as I'm looking at the investing. I care about how good the company is first. And once it's a solid company, then I start looking at the stock price. And then I typically just wait till the price becomes, low enough that I think the company's a good buy. And sometimes, for example, in the example of SEIC, I might follow a company for years before it's cheap enough to buy. And then when the time comes, I will have done my homework and I can really pounce on that investment opportunity. So here we see the gross margins. This is where I start my search. Gross margins is the total revenue minus the costs of goods sold. One of the things that I like about gross margins, when you have really high gross margins, that means that your cost to produce your product isn't great, and it means that you have lots of opportunity for things to go wrong and still be profitable. I liken it to when you fly an airplane. If you're at a really high altitude and something goes wrong, you have plenty of time to solve the problem, restart the engines, find a safe place to land. But if you're traveling around at 1,000 feet AGL, 1,000 feet above the ground, if an engine goes out, you're going to crash. You're going to crash, and you can see where you're going to land right now. And so when you've got companies with really low margins, they don't have much time to maneuver when things go bad. It's not very long from things being okay to things being really bad. Secondly, low margins tends to mean you're looking at a commodity business, which is a business based on price alone. And high margins tends to mean you're looking at more of a consumer monopoly. And a consumer monopoly is a company that has some pricing power and can still do well even in, for example, high inflation times, or perhaps times like we're dealing with now with the coronavirus. So having said that, when you're looking at gross margins, I look at a company in two areas. First of all, I like a company to have gross margins of at least 40%. This company has gross margins of, in the range of 70%. I think it's 68.5% last year. In terms of all the companies that I've looked at, about 950 companies, this company is in the top 10% or just under the top 10% of companies for gross margins. So in that aspect, it's spectacular. It's a great company and one that I'm very interested in buying the minute I see it. And again, Paychex is another company that I've been following for quite a while before it was cheap enough to buy. So it goes without saying that one of the things we're looking at is earnings, right? We want earnings and earnings per share to both be attractive. At the end of the day, what we're really looking for, everything else is sort of superficial. If the company's not making money, I'm not going to buy it. If the company's making tons of money, there's probably reasons why, and we want to understand what those are. So this company has, since 2020, had increasing profits 18 of 20 years. So only 2 years did they go down, and as you can guess, the 2 years it went down was during the financial crisis. But it didn't go down a ton when you look at this chart. It just went down a little bit. In the last, I think 9 years, the company has had an increase in profits every single year. So it's doing very, very well in terms of earnings. And I look at earnings both as what are they in an absolute sense and what are they doing over time? Are they going up and are they going up steadily? And this company's doing both. I also do at the earnings per share diluted. Earnings per share matters because if you're buying back stock, your earnings are going up faster than your earnings per share will be going up faster than your earnings. And that means that you're getting sort of a double whammy. You're getting a company that's both growing its earnings, that's great, and a company that's growing its earnings per share, that's even better, and you're getting two opportunities to make profit on the same increase in earnings. So this company, again, you're going to hear me say this over and over again, these 4 or 5 videos, but Paychex does an excellent job in both of these categories. So gross margins is the relationship between gross revenues and minus cost of goods sold. But the other thing that's really important is net earnings as a percentage of revenue. So that's just simply how much money did you make and what was the bottom line and what's the relationship between those two. And you can see this company's net earnings are in the range of 25%. That's spectacular. They're very, very solid. But also is important just in terms of, to give you a sense for where it is in the terms of all of the companies that I've looked at, it's been in the top 10% for the last 8 or 9 years. That means in the last 8 or 9 years, through everything that's happened, good and bad in the economy, this company has found a way to throw a higher percentage of their total revenues to the bottom line than almost any other company I could look at. So clearly that's something that's very interesting. Again, a very, very solid company. They do a great job. I've got nothing but positive things to say, obviously net earnings to revenues. So in every video I talk about my 4 taxes, and I've kind of increased it to what I call the 5th tax. So there are things that a company can't control, right? Their cost of goods sold to a large degree are a function of the industry that they're in. And so they just are sort of what they are. And if you look at most companies in a similar industry, their cost of goods sold are within a pretty narrow band of each other. But then there are things that management can control, or at least can have some control over, and that they still have to do and they have to spend money on. And the better companies do a better job of managing it, the better industries have better attributes for managing these things. And so these are really things that could be a potential benefit to the company or a big drag on the company's earnings. So the first one is selling and general administrative, right? That's kind of the cost behind the scenes to run the company. And this company is sort of average in selling and general administrative. They're neither great nor bad. One of the things to remember, though, is that this company has very low margins. I mean, very high margins, very high gross margins, because their cost of goods sold are very low. But some of that cost of goods sold gets transferred to selling and general administrative. A lot of what they do is, computer-based. You sort of program the computer to do something, and every month it spits out a result. That doesn't cost much to do. But what you do have to do is send your salesman out to go and convince companies to hire you to do it. And so this company's selling and general administrative is only average. And if everything was average, I'd be concerned. But that's not the case. Plants and equipment for this company are in the top 25% of companies, so they're very, very efficient. They're not the best, but they don't have to be the best. I just want them to be very consistent. The other thing to look at for both of these charts is that the lines are very, very flat. There's not a lot of gyrations. The economy can do what it wants. This company's spending about the same amount of money on selling general administrative and relative to their profits, and there's got about the same amount of their plants and equipment, their assets tied up in plants and equipment. And it's a very flat line. So that lets me know this company is very predictable. So I like predictability. I don't have to guess what's going to happen next year. So this is where a company like Paychex really shines. The company has no inventory of any kind. Again, they're just using people, right? People and computers are doing their resources. They're not selling a product, and so they have no inventory. And there's lots of reasons that benefits you. Having inventory means that you're tying up assets to control your product so that you can deliver it to your customers. So that means you have more assets tied up, but it also, or maybe you have more debt to carry that inventory. But it also means over time inventory can go bad. And if you come up with a gizmo, and a year and a half later you come up with Gizmo 2.0, all of the gizmos that were 2.1 that were in your inventory are now gone. All your inventories that were the first version of your gizmos are now worthless because everybody wants to buy Gizmo 2.0, and so you lose the money associated with the production of that inventory. So having no inventory is a great way for a company to differentiate itself and generate profits for us, the shareholders. The same thing goes with R&D. There's 2 things I like about a company that has very low R&D. The first one is they don't have to burn money every year to do that, to spend on research and development. The second thing I like about a company with no R&D is typically the companies with high R&D are companies that are selling gee whiz. And when you're selling gee whiz, that's only great until some other guy comes up with something that's even cooler. And think about the BlackBerry, right? The BlackBerry was the coolest thing in the world until Apple came along and crushed them. BlackBerry didn't do anything wrong. They just didn't do as good a job with their R&D as Apple did. Now look at this company, Paychex. They're not spending any money on R&D because they're not selling gee whiz. They're selling efficiency. They're selling, we do a better job of creating these goods and services than you can do yourself, because we have some economies of scale, and because this is all we do and it's all we think about. And so we're going to naturally be better at this, which is HR related stuff, than the average company, which is trying to do, which is a law firm and they're trying to provide legal services. They don't have time to understand the HR issues. So they're not selling gee whiz. That's reflected in the R&D, and that's one of the reasons I like companies with very low R&D. The next thing, which is sort of my pseudo 5th tax, it's something that a company has to pay. It's sort of a voluntary position they put themselves in. With selling and general administrative, that just is what it is. Your industry is going to require you to do some of that. The same thing with R&D, the same thing with plants and equipment. Interest payments are more voluntary. You've chosen to put yourself in a position to have to pay that. But the other thing about interest payments is they're not scalable. When you have a bad year, you can, if you choose to, reduce your R&D. You can control your inventories to some degree. But your interest payments, good years, bad years, the bank wants their money and you got to pay it. So I look at our interest payments as sort of a pseudo tax because it's just different than the other ones. This company is in spectacular shape for interest payments. First of all, they had no interest payments till about 3 years ago. They're still very, very small. And in fact, most of their interest payments is more than offset by interest income. So it's very, very small. And so I look at interest payments, I look at them from, again, several different points of view, and you can learn several things about a company by looking at the interest payments. The first thing is, if interest payments are going up, that means that their debt is likely going up. And if the debt is likely going up, you have to ask yourself why. What is going on that's causing this company to borrow money? Are they growing? Are they growing too quickly? Are they not throwing off enough cash to justify what they're doing in terms of growth? And how long have they been taking on more money? If they're borrowing money to grow, at some point you'd like that growth to be self-supporting and allowing them to pay down debt. So these are sort of red flags or green flags. This company's interest payments are really sort of insignificant in the scheme of things. The company makes over $1 billion a year, and they spent, I don't know, $20 million in interest last year. It's a nothing. And in fact, that's what the next slide shows, which is interest expense as a percentage of operating income. And it's so negligible, it's not even worth talking about. But I do look at both. I look at first, what are the interest payments and what does that scenario look like? And then I say, okay, wait, now I understand what's going on, but how does that really measure up as relative to the company's operating income? And oftentimes I'll see things that I don't really like about interest payments, but then I'll say, oh, but it's so insignificant, it's just not, it's a rounding error sort of thing. Other times I'll see a company that is doing a good job, they're paying down their debt year after year after year, and I go, well, that's exciting, they're doing things right. And then I'll look and I'll see that their interest expense as a percentage of operating income is 25 or 30%. And I'll realize that, yeah, they're doing a good job of trying to get this under control, but they're not investable today because that interest payment is so high, it could become a burden in the bad times, which, as you can see, is the kind of thing we're facing today. So, in summary about the company's operations, I look for gross companies with gross margins of at least 40%. This company's gross margins have consistently been above 68%, so it's spectacular. Earnings have gone up for 9 years in a row, and they've gone up for 18 of the last 20 years, so the earnings for this company are very, very solid. Due to stock buybacks, earnings per share have surpassed earnings in terms of their growth, so we're getting that double whammy that I like to see. Net earnings as a percentage of revenues have been in the top 10% of companies for the last 6 years, and before that they were still very consistently in a range very close to that, so net earnings percentage of revenue is excellent. Selling and general administrative is average at best, but property and equipment are in the top 25% of companies, so that's really good, and the company has no inventory or R&D cost and very little interest expense. So in summary, Paychex is a very, very well-run company in a very solid industry that has lots of fundamental advantages in terms of an investor. We're getting to buy this stock cheap as a result of the coronavirus. Paychex is a company that will come back, I think come back quicker than most companies. And so in terms of looking at the operations, it's pretty easy for me to tell you this is a company that you should strongly consider investing in. One final note, obviously I'd love it like every YouTuber if you were to subscribe and or if you were to like and or comment, especially if you comment with where you're from and what city and country you're in. Also, I'd like to invite you to follow me on Twitter. My symbol is @robinsonstocks.com. I don't always make a video immediately upon buying or selling a stock, but I always try and tweet about it within a few minutes of when I do that. So if you want real-time information as to what I'm doing, you'll find that on Twitter. You also find articles that I find interesting related to our stocks or the market or something Warren Buffett might have said. So if you're interested in investing and you just want a little quick fix, you might follow me on Twitter. So thank you very much for following. Thanks very much for watching the video, and stay safe, stay healthy, stay isolated, and we'll talk to you soon.